Every day, trillions of dollars move across global markets. From New York to Tokyo, London to Shanghai, money doesn't sleep and neither does AI. For decades, humans have believed they controlled the flow of capital, the rise and fall of stocks, and the rhythm of economies. But today, that assumption is being challenged. Algorithms, powered by artificial intelligence and machine learning, have quietly taken the reins. Imagine waking up to find that your retirement fund, your savings, and even the prices of everyday goods have been influenced not by human decisions, but by machines. This isn't science fiction, it's reality. AI-driven trading programs execute millions of trades in milliseconds, scanning data, predicting market movements, and reacting faster than any human could ever hope. The journey from human traders to machine-dominated finance wasn't instantaneous. It was a slow evolution, marked by the rise of computing power, the explosion of market data, and the advent of machine learning algorithms capable of analyzing patterns invisible to the naked eye. Today, these systems don't just assist humans, they often replace them, shaping market outcomes and even influencing global economic policy. This is the story of a silent revolution, one where milliseconds matter, algorithms dominate, and humans are forced to adapt or be left behind. The story begins in the 1960s and 1970s, long before the term artificial intelligence was a part of mainstream conversation. Early financial institutions experimented with computers to assist traders. At first, these machines performed simple calculations, tracking stock prices, computing interest rates, and logging transactions more accurately than humans ever could. As computing power increased, so did the ambitions of financial engineers. By the 1980s, algorithmic trading emerged, a system where computers could follow predefined rules to buy and sell stocks automatically. These were still largely rule-based systems. They didn't think or predict beyond their programming. Yet they were faster and more precise than human traders. The real transformation began with the rise of machine learning in the 1990s and 2000s. Hedge funds and investment firms like Renaissance Technologies, Citadel, and Two Sigma started experimenting with AI algorithms capable of analyzing vast datasets, learning patterns, and predicting market behavior. These weren't just simple programs. They could adapt to changing conditions, identify correlations invisible to human analysts, and optimize trades in ways no human could match. One of the most famous examples is Renaissance Technologies' Medallion Fund, often described as the most successful hedge fund in history. Using sophisticated algorithms, the fund consistently generated returns that far outpaced human-managed funds. Its AI systems could detect subtle patterns across global markets, from commodity prices to stock correlations, and execute trades with unmatched speed and precision. The rise of AI didn't stop at hedge funds. Banks, asset managers, and even small trading firms began integrating AI into their operations. Algorithms now analyze news feeds, social media sentiment, macroeconomic data, and even weather patterns to predict market outcomes. For instance, a sudden geopolitical event in the Middle East can trigger algorithms to sell oil futures before human traders even process the news. The key difference between early computer-assisted trading and modern AI systems is autonomy. Today's AI can not only follow pre-programmed rules, but also learn from outcomes, adjust strategies, and make real-time decisions. This has shifted the balance of power on trading floors. Humans no longer have the speed or data processing capacity to compete directly with these systems. Citadel, which is one of the world's largest hedge funds, employs thousands of algorithms running 24/7. During the 2020 market turbulence caused by the pandemic, Citadel's AI systems executed trades that minimized losses and even generated profits when human traders struggled to respond. Analysts estimate that AI trading accounted for over 70% of the firm's total volume, a dramatic demonstration of how machines now dominate markets. This rise has caused tension in financial markets. Traders who once relied on intuition, experience, and human judgment find themselves outpaced by milliseconds. Small delays or miscalculations can result in lost billions when competing with AI systems executing trades thousands of times per second. Yet, it isn't just about speed. AI systems can process data that humans cannot comprehend. They can track billions of data points, stock prices, economic indicators, global news, and alternative datasets like satellite imagery to make informed predictions. This has shifted markets from human intuition to machine logic. The lesson is clear. The era of humans dominating the stock market is over. AI doesn't sleep, it doesn't panic, and it doesn't make emotional decisions. And as we will see, the rise of AI is only accelerating. If artificial intelligence is the brain of modern finance, then high-frequency trading, HFT, is its nervous system. HFT represents the fastest and most aggressive form of algorithmic trading, a world where profits are measured in microseconds and advantage is measured in fiber optic cable length. High-frequency trading firms use ultra-powerful servers placed physically close to stock exchange servers. This process, called colocation, reduces signal travel time by fractions of a second. In a world where algorithms execute thousands of trades per second, those fractions become millions of dollars. An HFT algorithm might buy a stock, hold it for less than a second, then sell it for a tiny profit, sometimes less than 1 cent per trade. But when this happens millions of times per day, those pennies compound into enormous profits. The market itself has transformed into a digital battlefield. Instead of human traders shouting across trading floors, silent machines battle invisibly through code. On May 6, 2010, the U.S. stock market experienced what became known as the flash crash. In just minutes, the Dow Jones Industrial Average plunged nearly 1,000 points, then recovered almost as quickly. Trillions of dollars vanished and reappeared within minutes. Investigations later revealed that automated trading systems had amplified selling pressure in a feedback loop. Algorithms reacted to each other faster than humans could intervene. The crash showed a terrifying reality. Markets could spiral out of control without human understanding or oversight. This was a warning shot. Machines were now powerful enough to destabilize entire markets. High-frequency trading dominates because speed beats intelligence. A faster algorithm often beats a smarter human. Emotion is eliminated. Algorithms do not panic, hesitate, or chase losses. Scale multiplies profits. Millions of tiny profits compound rapidly. Data advantage compounds. Algorithms learn faster with more data. Critics argue HFT increases volatility and unfair advantages. Supporters claim it increases liquidity and efficiency. The truth lies somewhere in between, but one fact is undeniable. Humans no longer control short-term market movement. Machines do. Beyond speed trading, AI has moved into prediction, the ability to anticipate market behavior before it happens. Modern AI models ingest historical price data, corporate earnings, economic indicators, interest rate movements, social media sentiment, satellite imagery, consumer spending behavior. These systems detect hidden correlations invisible to humans. For example, an AI may notice that shipping traffic near Chinese ports predicts semiconductor prices months later, or that weather patterns affect energy futures weeks ahead. Traditional risk management relied on historical averages and human judgment. AI models now simulate millions of future scenarios in seconds. They stress-test portfolios against hypothetical crashes, currency shocks, pandemics, and geopolitical disruptions. During market crises, AI systems automatically rebalance portfolios, hedge exposure, and minimize losses, often faster than any human committee could react. However, AI is not perfect. Algorithms learn from historical data, and history does not always repeat. When rare events occur, models may fail catastrophically. The danger is not that AI makes mistakes, but that many AIs make the same mistake simultaneously, amplifying risk across the entire financial system. Modern investment banks resemble technology firms more than traditional financial institutions. Trading floors are now quiet rooms filled with engineers monitoring servers. Banks employ quantitative analysts, quants, machine learning engineers, data scientists, algorithm auditors. Traders increasingly supervise algorithms rather than execute trades themselves. Algorithmic control of markets. AI influences stock prices, bond yields, currency exchange rates, commodity prices, derivatives markets. When algorithms collectively buy or sell, markets move regardless of human opinion. A surprising consequence: market psychology has become machine psychology. Traders now attempt to predict what algorithms will do, not what humans will think. AI doesn't only control Wall Street, it controls ordinary people's money. Platforms like robo-advisors automatically allocate savings into diversified portfolios using algorithms. They rebalance, harvest tax losses, and optimize risk continuously. Millions of people now trust algorithms to manage their retirement funds without speaking to a human advisor. Your pension fund, insurance fund, mutual fund, and ETFs are often managed or influenced by algorithmic strategies behind the scenes. Even if you never trade stocks, your financial future may still be shaped by AI decisions. Benefits and risks. The benefits of AI: lower fees, faster optimization, reduced emotional bias, greater diversification. The risks include hidden systemic exposure, over-reliance on models, black box decision-making, limited human accountability. The average investor may not even realize how much control has shifted away from human judgment. AI trading doesn't respect borders. A trading algorithm in New York can move markets in Tokyo, London, Lagos, Sao Paulo, Mumbai. Capital flows move at digital speed. Emerging markets can experience sudden capital inflows or outflows triggered by algorithmic signals rather than local economic reality. This can destabilize currencies, raise borrowing costs, and amplify economic shocks in vulnerable countries. Cryptocurrency markets are almost entirely algorithm-driven. Bots dominate liquidity, arbitrage, and price discovery. AI models trade 24/7 with no market closure, accelerating volatility and risk. Regulators struggle to monitor systems they cannot fully understand. Algorithms evolve faster than laws. Global coordination is weak. Transparency is limited. The world's financial infrastructure has become more complex than any human institution has ever managed. The next frontier includes self-learning autonomous trading systems, quantum computing acceleration, AI-generated financial strategies, fully automated markets. Some researchers predict that future markets may operate almost entirely without human involvement, humans becoming policy supervisors rather than participants. If machines control capital allocation, investment flows, and risk pricing, who truly controls economic destiny? Governments, corporations, or algorithms? The danger is not malicious AI, but misaligned incentives, cascading failures, and systemic blind spots. Who controls your money? The answer is no longer just banks, governments, or investors. Increasingly, it is algorithms operating at speeds beyond human comprehension. From high-frequency trading to robo-advisors, from global capital flows to crypto markets, AI has quietly become the nervous system of global finance. This transformation brings efficiency, opportunity, and innovation, but also fragility, opacity, and systemic risk. Humanity has handed the steering wheel of money to machines, not fully understanding where the road leads. And the greatest question remains: can humans still control the systems that now control their wealth?